Now, we're moving on now to the very bedrock of why we're all here, of our industry, to discuss the world's first blockchain, how it's evolving, and we will welcome onto the stage co-founder and CEO of Blockstream, Adam Back, and moderator and legend, Dan Held. And we're going to be hearing a lot about the Liquid network and Blockstream's full stack. So please put your hands together and a big round of applause for Adam and Dan. Thank you, folks.
Hello. Just wait for the slides. Okay, so I'm going to talk about Bitcoin Layer 2. So Blockstream has been around since 2014. We were very early in developing Lightning, the most well-known Bitcoin Layer 2. But we also developed something called Liquid starting in 2015. The network went live in 2018. It is more similar to Bitcoin, so it's basically a branch of Bitcoin with some additional features, that being confidential transactions, so not exactly privacy, but the transactions are such that you can look at them in a block explorer. If you're not party to the transaction, you can't see what asset type it is, if it's a stablecoin, if it's a Bitcoin, and you can't see the value, the amount of a transaction, the amount of the change. And so it gives you an interesting form of privacy, which is confidentiality for the amounts and for the asset types. This chain, Liquid, has native asset support, so you can issue and the network can actually natively understand the type of the asset. So it's not like a color coin scheme or like RGB. And so you have the native understanding of the assets, and you can do very simple types of atomic swaps. So that's used for kind of DeFi-like things, so that you can place a limit order, sign a transaction, have a central order book, match that without custody, and there are wallets doing that kind of thing. So with Blockstream, we are in the Bitcoin Layer 1 space with hardware wallets, software wallets, HSMs for general Bitcoin users for cold storage. We have a Lightning, Liquid, and Bitcoin hybrid wallet that gives you the advantages of Lightning and the ability to do storage on Liquid and on Bitcoin and to move between those layers. And we have also enterprise wallets, so for businesses and ultimately for custodians, so HSM-based wallets for custodians. So I think people tend to think about Bitcoin as just the asset class, but actually Bitcoin was obviously the first blockchain, and the one with the longest track record, the best Lindy effect, but also came with smart contracts, and Liquid extends that a little bit. So firstly, it's had covenants since the beginning. It had Schnorr signatures before Bitcoin. It had the time lock opcode before Bitcoin. Recently, we added shrinks, which is one of the post-quantum signatures. So that's also live on Liquid. And it has a self-extensibility mechanism, which is simplicity. So a lower level smart contracting system, you can think about it like microcode to implement opcodes or something like that if you're into programming. So between Lightning and Liquid and Bitcoin, you have a great deal of interoperability. I think the other thing that's evolved in the Bitcoin Layer 2 is that Lightning has become the interoperability layer. So people are moving Lightning, making channels, doing atomic swaps with Liquid Bitcoin with Lightning to rebalance channels. So they're able to get in and out of Liquid Layer 2 using Lightning. They're able to move balances into Arc and other new Bitcoin Layer 2s using Lightning. So Lightning has evolved to be the kind of interop mechanism, the go-to interop mechanism. So I think Liquid is a critical part of this. You've got the confidentiality, native asset issuance, and rapid settlement. So the analogy for mining on Liquid is actually signatures, block signing, by a network of validators who are generally Bitcoin ecosystem companies. There are about 80 members in this network now. The size of the network and the membership of the network, the people with the HSMs that sign the blocks, has a way to evolve. It's currently 15 with a kind of quorum signing, and those blocks come out every minute. The blocks are actually the same size and weight as Bitcoin blocks, but they're 10 times more frequently because it's 1 minute instead of 10 minutes on average. So you get similar kind of capacity though because the confidential transactions are bigger. There's a size overhead for that. There's about 5 billion of different kinds of assets on Liquid between stablecoins, tokenized shares, MicroStrategy, MetaPlanet, recently Capital B, which is based here in France, and H100, a couple of billion worth of promissory notes, so small business loans in a kind of digital bond format, and various other assets, some corporate bonds, some hash rate contracts. So I think, that Liquid has a lot of the benefits of predictability, Bitcoin's security history, because we make very targeted and careful changes on top of the Bitcoin code base, and so benefit from Bitcoin's security track record and security focus. We aim to retain that in Liquid. The Blockstream development team also is very big in the development and maintenance of libsecp libraries, which is the library that the Bitcoin network uses. And we have extended version of that adds confidential transactions and some of the more new privacy and confidentiality-based cryptography, for example, for the Schnorr signatures and bullet proofs and things like that. So we began with a simple idea. The vision of Bitcoin was beyond a store of value. And so as the space matures, we see different types of entity entering the space. Companies, with the evolution of the phenomena of companies using Bitcoin as a treasury asset. Blockstream itself was kind of a very early treasury company in that with our seed round in 2014, we negotiated with the initial investors to put some of the capital into Bitcoin. And so we had some of our cash reserves at all times in Bitcoin over the years. But now you see, all kinds of entities, pension funds, some US states, some governments doing mining, some sovereign wealth funds investing in Bitcoin, and infrastructure building around it as the traditional finance companies are starting to want to hold Bitcoin or work with custodians, and some of the custodian banks now want to become digital custodians or partner with existing digital custodians. So we think that Bitcoin is, the best, or actually the only investable crypto asset, in my view. People's opinions may vary, but also the most dependable and security-focused chain that's been around the longest. And so we think it's the conservative choice, ultimately, to use Bitcoin and Bitcoin Layer 2. It's also a neutral choice because Bitcoin is a decentralized asset class where there is no company in control of it. And so I think that's another useful aspect of Bitcoin, that sometimes companies don't like to use the competitors' products, right? So if one exchange has a stablecoin, the competing exchange won't want to use their stablecoin, or one exchange has a layer 2, or a blockchain that's their blockchain, then the other exchange won't want to use it. So I think Bitcoin benefits from being a neutral platform for all parties. So thank you.
Hey everybody, appreciate the talk, Adam. And I'm really excited for this portion as we dig into a few more questions around the Blockstream enterprise side, also talking about Liquid, and eventually, if you stick around, we're going to be talking about some interesting things on quantum, which we were chatting about backstage. So, with that, Adam, when we look at kind of the earliest days of Bitcoin, how are these conversations you're having now with institutions in contrast to the world of Bitcoin 5, 10 years ago?
Well, I mean, I think you got a gradual introduction of different types of entities getting involved with Bitcoin. And, for people who were around early on, originally there was nothing but users. And then some very small, sort of scrappy startups, and then exchanges of various grades of maturity, a number of hacks or like security accidents, I guess, along the way, and a great deal of regulatory uncertainty and risk, much of which has actually resolved and improved over the years, which is good. And so, I think when Blockstream started in 2014, we were actually quite uncertain, what would happen with regulations. And there was a long period where banks didn't really want to hear about Bitcoin, and they were interested in the blockchain. But now that's kind of turned around, and most of the major banks are, in market, adding Bitcoin exposure, putting out model portfolio recommendations, and trying to bring to market their own ETF or partner with ETF providers. So it's really a different world. And I think the other thing that people quite often ask is there risk to Bitcoin's ethos along the way? And I don't really think so, because Bitcoin is not a neutral technology exactly. When people get interested in it, they have this falling down the rabbit hole phenomena, and they get philosophically interested, and it starts to change the way they see the world and money. And so that's still there. And of course, a key part of Bitcoin is the bearer unseizable asset. So I think whichever path people come at it, whether it's via retail payments, a coffee shop, a Bitcoin-linked debit card, they always end up learning the rest of the story and getting fascinated by it. So I think that's still there. And so as long as you have the option and the capability to cold store your Bitcoin, to control your own keys, we're good. And the ETFs and these financial products are just a kind of usability feature. So they make Bitcoin more accessible to a wider range of people, which is ultimately good.
I really like that point you brought up around with the institutions and enterprises coming into Bitcoin. Does that make Bitcoin different than what it used to be, or did it change Bitcoin? And I like to say, Bitcoin's code has barely changed. There's of course been a bunch of different upgrades and improvements, but the core ethos of Bitcoin is in its code, and that code hasn't changed that much. And we're not seeing Bitcoin change on behalf of BlackRock. We're not seeing Bitcoin change on behalf of Goldman. They're bending the knee to Bitcoin.
Right. It's almost amusing for us, because we lived through the kind of governance war where a number of corporations tried to influence Bitcoin's protocol. And there was a similar event in internet protocols 20 years before, like in I think the mid-'80s, slightly before the time I was paying attention to internet protocols. But that led to the design of this rough consensus and running code phenomena in the internet protocols where the users won. And coincidentally or not, Bitcoin's kind of technology evolution in the protocols is using that very same process. And it's a battle-tested process for, basically what you end up with and how it works is that you end up with a great deal of inertia. And if people can't agree, then nothing happens. And so, it's very hard to change it. And so, to what Dan was just saying there, that, not only is Bitcoin, largely the same, but a great deal of people with, arguably a lot of influence and power tried to change Bitcoin and basically failed. And so I think it's more that Bitcoin changes you than you change Bitcoin. Yeah.
And with Blockstream over the years, you guys have focused on quite a few different things. I remember when you guys were first created, all the way back, in 2014. It's been a long journey for both of us in the space. And for Blockstream today, when you all are looking at these enterprises and institutions, and I know you were just on stage talking about that you're talking to governments, corporations, et cetera, what's probably like the number one asked for service or products?
I mean, people are interested in different things for different purposes. So, there's quite a bit of interest in stablecoins, in reliability and dependability in sort of layer 2 and smart contracts, because there was a period where all the banks were, they started their blockchain R&D lab, and at some point they came back to us and said, well, we've done the proof of concept, but we don't think that stuff is safe for production use. So then they became more interested in the kind of Bitcoin layer 2, because it's more of a sort of conservative, simple and safe, robust approach, rather than full-featured, easy to change scripting environment. So conservatism and security matters. So it's one of the interesting things about some of the institutional users. They are more systematic about understanding risk. So even a tail risk, they'll want to understand it, and that's because they feel an obligation to their, to downstream to the investors in their products and things.
And when they're looking at, Bitcoin, for example, if they want to do DeFi or if they want to enter that world and they're exploring, you mentioned this before, they're looking for something super robust, secure. If they're looking at Liquid versus other Bitcoin L2s or other blockchains, what is their calculus between those three? You already mentioned security. What are some other properties that they look for?
Yes, I think the other innovation that we brought to market with Liquid was confidential transactions, and actually that was the impetus for starting Blockstream in the first place, which is, when I got actively involved with Bitcoin in 2013, one of the things you could see is that Bitcoin is decentralized and robust and survived and, had bootstrapped, I would say, financially, right? In 2013, the price crossed over $1 and then $100, and there were half the coins mined, so that was $1 billion market cap. So, I mean, of course, today it's like over $1 trillion, but at the time that seemed like a pretty big milestone. And so the thing that some people were concerned about is that it didn't have much privacy. And the old electronic cash systems dating back to like 1990s had extremely strong privacy, but unfortunately they're completely centralized, so they failed, right? And so I had some experience implementing some of these protocols, so I knew how they work, and so I set about trying to improve Bitcoin's privacy. And what I came up with was confidential transactions. So I talked to the developers and sort of said, do you think Bitcoin would integrate this? And it became apparent that it's difficult for Bitcoin. We were just talking about the consensus process. It's very difficult to get consensus for a large change with complex new features in it. So I kind of pivoted to, well, I guess what Bitcoin needs is a modular layer 2. So that became Liquid, and then of course we put the confidential transactions in there, because the point in the modularity is you get to deploy exciting tech like this and prove it out with real value. And then there's a bit of a track record in Liquid where we implemented some things that later came to Bitcoin with improved versions that learned from minor things that could have been improved about what we did.
So kind of summarize, with Bitcoin, we want to keep it secure and we want to be very careful about changes that we make. And it's also very hard to make changes in the base layer. But on layer 2s, we can have this world, this garden of all sorts of different types of new transaction types for privacy, smart contracts, kind of a little bit more liberal playground. Is that accurate?
Yeah. I mean, so it's largely the same code. So we try to, and we maintain, we keep up with Bitcoin upgrades, so we get the benefit of Bitcoin's security track record and evolving improvements in the security domain, and then we add on, these other features like the confidentiality, the native asset support, covenants. So Liquid's had covenants, and simplicity, which is pretty exciting. So that was introduced much more recently. That's been long in the works in its a kind of lower level self-extensibility mechanism, which was originally proposed for Bitcoin before Blockstream, and then we picked up the challenge, hired the main proponent, PhD researcher Russell O'Connor, built a team, and spent quite a few years building that, and so that's live on Liquid now. And it is one of the candidate ways that Bitcoin could resolve this kind of dilemma about long discussion about which opcode to add and which variant, which is you don't need to do that if you have some lower level simple extensibility, because then you can build other opcodes later. And so paradoxically, that kind of generality is maybe easier to get consensus for. But I think that if it comes to Bitcoin, would be a slow thing that would take some years.
And earlier we brought up that institutions and enterprises are very security conscious in terms of looking at all the sort of risks that they have when interacting with Bitcoin and trying to get those mitigated. One of those, which I think is a pretty hot topic currently, is the quantum risk. So with a quantum computer, there's theoretical risks where it could hurt Bitcoin. And so I want to delve into this a bit. Would you kind of summarize the overall sort of worry that folks have?
Yeah, I mean, so the the prospect of quantum computers, I think that was, first raised probably in the 1990s. I went to some university courses in the early 2000s when I lived in Montreal. So some of the universities there had some of the top global researchers in quantum computing and the mathematics of it and the algorithm design using that hardware if it could be built, right? And so I kind of, because of that exposure to it, I was loosely tracking, what's the progress on the hardware? And it's been slow going. It's been 25 years, and it was, gradually improving a few qubits per year. And, the physics research has moved a long way, but it still feels like lab experiment stage. It's but I think if they get the funding and they keep doing the research, eventually it may overtake current computers. But for today, it's less powerful than a $5 calculator, and that's just the current state of the art. So it's not threatening to anything today. But in the further future, once they get to a scalable architecture, because people are thinking about the origins of the silicon-based CPU, right? And so the first CPU, I think, had a few thousand gates, and it was on a very large lithography. But once they got that to work, they were able to optimize it in iterations, and you've got the famous Moore's law effect, right? So people are thinking that's coming for quantum computing, but they don't have that because they haven't figured out what the silicon is. So they're still doing experiments with different physics architectures. But once they do, solve some of these technical challenges and have a repeatable architecture, then maybe it will start to make faster progress. So that's the question mark. And it's not, it's not even clear if it will necessarily work, because it's different, right? There are some error correction issues, lots of complicated issues which may get worse as you scale it and end up not being controllable or undo the benefit or use too much power or too much classical compute to do the error correction. So lots of open questions, but there's a nugget of some potential enormous advantage in there if it can be realized.
And to hop in, just to quantify this risk, the risk is around cracking private keys, right?
Right.
Yeah. So this is a pretty serious issue if this were to come into effect, and quantum computers are very good at that hypothetically.
Yeah, so they are good at, so they're not going to be better at everything, even if they're fully realized. However, they are good at sort of parallelizing some kinds of search problems, and that kind of algorithm can potentially undermine the security of digital signatures that Bitcoin relies on. But it doesn't have much effect on the mining and hashing and some other things. So it's localized as one specific thing. And so, of course, Bitcoin critically depends on digital signatures. Now, the question is, well, what could you do about that? And, well, indeed, there are solutions, there are digital signature methods that are using hashing, for example. So they are not much affected by quantum computing. And so there was an initiative by NIST, National Institute of Standards and Technology in the US, with international, collaboration to reach a standards proposal for post-quantum signatures, and that ran for some years. Many of the candidate algorithms got broken before they, so not only did they not meet the security criteria, but they were outright broken. So if you'd rapidly used them, you might have now lost your coins. So it shows that it's good to be cautious and wait till, there's been a lot of peer review on things. And ultimately, the signature scheme they're using is actually a 1979 scheme called Lamport signatures with a lot of optimizations. And Leslie Lamport is a very prolific, old school computer science guy who is also the author of the Byzantine Generals problem paper and the implementer of the LaTeX typesetting system. So he's just a busy computer science guy, an old guy now. But so that signature scheme is what NIST standardized on. And however, the signatures are quite big. And so Blockstream Research and others in the Bitcoin kind of R&D space that focus on cryptography have been trying to optimize that in a Bitcoin-specific way, because the way it's optimized is quite general, and so you can do better for Bitcoin's use case. And so Jonas Nick and the team proposed, the original system was called Sphinx, and so we proposed shrinks and shrimps, which were sort of Bitcoin-specific optimized versions that takes it down from multiple kilobytes, which is a bit hard to accommodate, to 324 bytes with shrinks, and we actually implemented that in Liquid so people can try it out.
And so that what we're covering here is that there are some solutions to the quantum computing problem if and when it becomes an issue, which is a big if and when. You and Nick Carter have had some back and forth on Twitter about this. I think one of the kind of core crux of his argument, I think, is that some of these improvements may come in a non-linear fashion. How do you feel about that, kind of like his thought process behind that?
Yeah, I mean, I think, because of the experimental lab stage of the hardware, it can be tempting to get stuck in a debate of, well, is it going to be 5 years or 10 years or 20 years, right? And that's hard to predict. So far it's looking like 20 years, but the optimists and the people who are, close to those things and maybe have a vested interest in them would say it's faster, right? But I think ultimately we don't need an answer to that, because for safety reasons, it's important for Bitcoin to have a long time to prepare. And so the way we're looking at it is, well, let's, figure out a post-quantum signature proposal and try to find consensus for integrating that into Bitcoin as a new opcode sooner, like in the next few years. And then people will have a decade to migrate, and they can be ready for quantum computers without paying the cost of it today, which I think is the other important thing. So because with Taproot, it's kind of a technical point, but it introduced Schnorr signatures and a way to have a hidden additional way to spend. So, today you can spend with Schnorr signatures, which are very compact, same efficiency as all of the existing Bitcoin transactions. But once you're in this quantum-ready format, if and when the quantum signatures happen, you can stop using that and switch to, this 324-byte or something new that's developed. So that's good. And if it turns out that it's faster, well, we've been prudent and people have started to upgrade, so they can hurry up, basically, at that point.
So even if we solve the technical side, though, it opens up two political sort of issues. One is typically these post-quantum secure transaction or signature types, they're typically very large currently. So we have, and you can choose which one you want to answer first, but we have larger signatures, which could open up the debate for a larger block size. We also have the issue of if private keys can be cracked, Satoshi's coins and other old coins those coins could be hacked by the first quantum computer. So whichever one you want to start on, how should we solve those more political, social problems rather than technical ones?
Yeah, I mean, I think these optimized schemes, because the NIST scheme, if you take it as standard, is pretty big, and that is actually a problem because it's hundreds of times bigger signatures. So you're going to go from 4,000 transactions per block to like 80 or something, which is pretty disappointing. So then, do you need bigger blocks? And then does it become expensive to run a node? And we get back into that block size debate. And of course, networks are a bit faster, computers are a bit faster, disks are a bit cheaper, but still not something you would ideally want to have to contend with. So I think the shrinks protocol which keeps the conservative hash-based signature security assumption, but gets you down to 324 bytes versus 64. So it's bigger, but not horribly bigger. And maybe there's some debate to be had about increasing the witness discount. So in other words, like slightly bigger block, because it wouldn't have to be that much bigger. Where the NIST, 100 times bigger, that's going to be difficult, right? So that debate can be had. But then you raise the other interesting point, which is, let's say this gets added as an opcode, people start migrating, you can get visibility of how many of the coins have migrated, and eventually it becomes more pressing. The quantum computer starts to be able to do simple calculations, and then you've got the debate about, well, what about the people who lost their coins who couldn't migrate? What happens? And so I think you can already see people, because it's a kind of hypothetical debate at this point, people love those debates. So it's already getting heated before it's relevant. And so some people are typifying it at each approach as theft, right? So if you just leave them, then some people with access to quantum hardware and a kind of gray zone ethical outlook will say, well, we'll steal them and we'll use it to pay for our quantum computer, or we'll steal them and we'll try and figure out who they belong to and charge a fee to give them their coins back or something. Well, if they could prove they were their coins or they still had the keys, they would have taken the coins. I mean, you never know who owns coins unless they have the keys, so that's kind of a non-starter. But it's pretty much guaranteed that some won't move because the keys will have been lost. I mean, it's for certain. So I think we can have this debate maybe in 10 years after we've seen 90% of the coins migrate. It becomes a much easier conversation then because it's concrete. There's a real threat, presumably, if that's the case. And we're informed by how many coins have migrated, and that might give us a hint that, probably there's a lost coins, so you're not really depriving of anybody of anything if you deprecate a now insecure signature scheme. And my argument is also that there's a long history of this, right, in internet protocols. So SSL, the protocol that secures web security, it had some algorithms that became insecure just to cryptanalysis of mathematicians finding flaws in things, and they just phased them out, they deprecated them, right? And so that is the approach, and the same was true for prior signature schemes and hashing algorithms. This has happened before. So if you use that approach, what would happen is you would just, you've got a long time to migrate, and then you can't rely on that in the future. And so generally they get deprecated, which in Bitcoin terms would mean there's a soft fork and it doesn't work anymore, right? But if that's after a decade and you're reasonably confident that people lost their coins, but ultimately it's an ecosystem decision. So it might get heated and people have non-crazy arguments for either case. So we'll see how that transpires. But I think it'd be a lot easier and more informed debate when it's concrete and you've got the data than today when it's a nice bike shedding argument.
Yeah, I mean, if people have 10 years to move the coins to migrate to post-quantum cryptography signatures, then it's sort of like you didn't move it in 10 years, and we're doing our best job as custodians of the network, which means every pleb running a node, every company working in this space, we're all trying to upgrade it to survive this moment. I have kind of a fun question around Satoshi's coins, because that becomes a big question of like, well, what do we do with Satoshi's coins? Why didn't Satoshi send his Bitcoin to an unspendable output? As in, an unspendable output means he could burn his coins. Why just hold on to them and never move them? Why not provably burn them instead? Do you have kind of a hypothesis as to why he did that?
No, I mean, I think actually Satoshi's coins are, one of the debates is they are in the original format, which was a bare public key. And after the HD wallets were introduced, I think that was in 2015, almost all wallets moved to this new format because they had a much safer backup. You got the seed backup, right, which was completely missing before. And those address formats are hashed. So if you don't reuse addresses, you have some initial protection against quantum computers. But old keys don't have that. And, it looks like most of them haven't moved, right? I mean, in the first year, for context, there were 2.5 million coins roughly mined in the first year. That was the rate, 50 Bitcoin per block for a year. And it's estimated the Satoshi thing that Satoshi might have mined 500,000 to a million coins. So you could see that at maximum 40% of the coins in that year would have been his, maybe less. I don't know how far forward the Satoshi pattern stretches. Maybe it's longer than 1 year. So, there's lots of other people there, and so a lot of those era coins didn't move. So I don't know why that is either. Maybe some of those old miners just want the privacy of just keeping the UTXOs, but we'll get to, and occasionally they move, right? So I think, this migration to post-quantum ready address formats maybe will tell us how many of those coins still have, where the original mining owner still has the keys, right?
I do think people overestimate how hard it is to manage your private keys for 15 plus years. It's a struggle. I mean, before BIP39, which is your 12 to 24 word backup, you used to print off your private key and then clear your printer cache just in case there's an exploit there.
Yeah. I mean, I think the Bitcoin Qt client from back in that period, before the HD wallet stuff, it was generating 100 private keys, one for each address, and you had to back up that file. And so if you used it a lot and you ended up creating more than 100, you had to back it up again. And people didn't necessarily know this, right? So if you used 200 addresses and you only backed up once at the beginning, you could also lose money that way. So there was some rough edges on the backup. And so the HD wallets was really a clever innovation, I would say. Made it much safer and reliable to back up, easier to work with.
I mean, I guess we could maybe say Occam's razor here. What if Satoshi lost his private key? Which would be quite hilarious.
I mean, it might happen. Who knows? Yeah.
He is a human after all, so it could have happened. And to your point, we don't actually know if those are Satoshi's coins. The Satoshi sort of fingerprint. Yeah. We hypothesize those are his coins, but it could have been another early miner. We don't know.
Yeah, I mean, it's also for people's context. So Sergio Damon Lerner was the first person to observe this, and I think Jameson Lopp and a few other people have kind of repeated some of the analysis. But basically, in the mining, there is a high-resolution counter, the microsecond hand on your stopwatch, and then there's a low-resolution timer, which is it's a counter. It's going up slowly, and the software made a kind of coding error, which is it doesn't, randomize or reset that counter. So if you see this counter just gradually going up, so people draw a plot, and if you see these kind of straight lines where, before the counter wraps around, it looks like it came from one miner, but there are lots of miners of different sizes. So over time, there are more and more miners, and it gets more and more noisy, and so you've got false positives and negatives. Like that looks like it. Did that belong to that chain, or was it a separate one? It starts to become blurry. So when people say that, Satoshi had 1 million coins, it might have been 500,000. We don't exactly know. And did he spend any of the coins? People say he never spent any of the coins. And it's generally true that not many of the 2009 coins have been spent, but only 40% maximum were his. And, it gets more blurry at the later end. So maybe he spent some more recent coins. We wouldn't necessarily know. Those would be the most private because there's most ambiguity in this pattern. But anyway, if you look up Satoshi, you'll find some of these articles by Sergio and Jameson Lopp and others.
Yeah, I remember reading Jameson's piece on this, which was quite good. We're at time, but I do want to ask one more question. Looking forward, what are some of your predictions for institutional adoption for Bitcoin over the next year or two?
Yeah, I mean, it's quite interesting because, the Bitcoin market has gone sideways at this point. It's starting to show some strength again, but I think what happened potentially is that people heard institutional adoption and they saw all the news flow and they expected the buying behind it to hit immediately. And institutions are more systematic and process oriented than that. So I think it hasn't happened yet, largely. So, in effect, you'll hear from one big investment bank with a lot of wealth management clients or mutual funds and managed funds that they are putting out a model portfolio or they're going to offer it to their wealth clients, but then they'll have a 6-month process to write some guidelines for the sales teams. They'll do the training. They'll talk to compliance and legal. They'll select a custodian, and all these things take time. So, there are some early indicators that they've been doing it. I think you could see from the BlackRock filings that about 30% of the coins were institutionally held. But I think, the other 70% are just individuals who manage their savings via a broker or a financial advisor who, called up their advisor and asked to get some Bitcoin exposure or something like that. So it gave access to people that wouldn't necessarily buy Bitcoin on a Bitcoin exchange, but I think the actual allocation to the managed funds, and see, the other context is most people in the world are not making manual investment decisions. They don't have a self-directed stock portfolio, they don't have a stock portfolio at all. Their savings are in the form of like a life insurance policy or an employment, managed fund. So it's all managed by professional money managers, and that's probably most of the money in the world that's in that format, right? And so those professional money managers have got to go through this process. And ultimately, I think that is good because, as Bitcoiners, we always want, benefits of Bitcoin to be available to everybody. And so because a lot of people don't do their own investment decisions, the only way they're going to get the exposure is via these institutional money managers that are managing pension funds and life insurance products and things like that. So I think it's still to come, and is a sort of later wave that will kick in, presumably over the next few years.
Well, appreciate that final word, Adam, and thanks for everyone for attending. So we'll see you all later.
Welcome to Signal Week.